We need to keep an eye on this rotation that's taking place between risk on assets and risk off assets. Right now, when I'm looking at the mega cap growth stocks, so Facebook, Apple, Nvidia, Google, Microsoft, Amazon, Tesla, relative to the S&P 500, take a look at the chart. They're all pointing down at this particular point in time. And now when I take a look at a safety type trade, many of these are all pointing up. What are these? Well, it's gold relative to this S&P 500, utilities, consumer staples, defensive names, and healthcare. You can see bonds actually is a risk off type asset, but this bonds have been getting completely destroyed as of recently. And we'll touch that more of that in that particular section. And then if you want to dig even deeper into various industries, tech industries here, we're looking at software, computer service, electronic equipment, and so forth down the list. All of these have been flat to pointing down as well, and really taking a big hit is semiconductors. And semiconductors, as we all know, are incredibly important to the NASDAQ. Why is this kind of stuff important? Well, this is the orange right here is a stock market cycle. The blue is the economic cycle. And the stock market cycle, if you visualize it, really leads the economic cycle. You can get a head start on it. And really at the top of market cycles, energy starts to perform. But as you turn, consumer staples, healthcare, and utilities. Now, year to date, almost every sector was down except for energy. But this is very interesting. Take a look here what's taking place. We now have 4 sectors in the green. Okay, utilities, consumer staples, and healthcare now are all in the green year to date. Meanwhile, everything else is down there in the red. Energy continues to hold up, and we don't know how high it can go, to be honest. Actually, it just broke out recently, and it looks pretty strong. We'll touch on that, okay? You're watching the Stock Market Brief Show. My name is Michael Silva. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed at next. We're going to talk about crypto today. We're going to look at weekly charts, daily charts. We're going to talk about some of the earnings coming up. We're going to go over indicators, the dollar, commodities, bonds, and yields. Today's an action-packed episode, people, so let's just go ahead and get right into it. All right, so first and foremost, we're going to go over the daily chart of Bitcoin and then the daily chart of Ethereum. We're on the ftx.us website. I use these guys personally. They sponsor my episode. They support this show, so I'm a big fan of them. If you use this, you can use the link in the description below to sign up. Now, with this, you can trade crypto up to 85% lower fees than the top competitors. You could also use the FTX app to buy your favorite NFTs with no gas fees, supporting both Ethereum and Solana blockchains. If you do download the app, you can use my code TRADERMIKE, which will be in the description as well. Me personally, for more advanced use, I like to use the ftx.us website. And by doing so, it allows me to use TradingView, map out key levels, and then also place my orders right here from the site. Okay, so daily time frame for Bitcoin. We did get that back test, and now we're starting to see a little bit of weakness here, but we're still holding that 50-period moving average. As far as the RSI and the MACD goes here, we still have that bearish crossover taking place. So right now on this big recent run-up, we haven't seen any strength come from it. So right now, it's literally just reversing. We need to see the back test actually hold here. So right now we're just sitting on that 50-day moving average. It has a little bit of time, and I think you're going to really like what I see here on the weekly time frame when we show you the Saylor to Schiff tool. When I take a look at Ethereum over here, this one is currently holding this back test area. Remember, we drew it out kind of similar to Bitcoin, where it says, kind of looks like it can potentially head lower. That's still a possibility, because what I am seeing here, if I bring up I'll draw it out. I'm only going to draw one line here, but you can see how it's kind of just angling up. So do you see how it's, we're putting in higher lows right here, and it's kind of just angling itself up? This very well could potentially be a bear flag that is forming, and that is something that we need to just be, cognizant of. So for example, if this is the pull that's down and it did so on some inclining volume, if this breaks down, we're looking back at around 3,000 to potentially lower for a back test to complete with Ethereum. And then we need to see if strength comes back in. All right, so let's look at the Saylor to Schiff tool. Actually, before we go over the Saylor to Schiff tool, I want to show you the weekly time frame. This is important here. So there is a difference between this last drop off and this drop off. What I'm seeing here is this was a falling wedge, which is more bullish. And during that time, we actually saw the RSI start to uptick and get above that 50. Here we have what's known as a bear flag or a rising wedge, which is actually a little bit more bearish. Now the structure hasn't been broken yet, but it's something that we need to be mindful of. And during the RSI right here, you can see that it's back below 50 and pointing down. Now what I find very interesting here is when you pair this with the Saylor to Schiff indicator. Now, as we stated, this was a falling wedge, this was a rising wedge. And what do we see the difference between what was going on with the indicator at that time? Well, during this time while this was turning up, our indicator was turning up right before that buy signal. And as it stands right now, look at where the indicator is. It's actually up the upside, but turning back down. Now, we haven't crossed down through zero yet. So, it's still holding strong at this particular point in time, but it is something to be quite mindful of given the context of how this chart is laying out. So we can't be shocked, if all of a sudden we get a sell signal coming up here in the very near future, as we're starting to see some type of strength in gold, okay? So if you don't know this indicator, you can watch the episode. I'll link it in the description below that walks you through how to use this specific indicator. Okay, so that's some interesting stuff taking place in crypto. Let's go and head into the indices, both weekly time frames, and then we're going to go into the risk ranges. First and foremost, how did the week perform? Okay, take a look here at the top performing sectors: XLV, XLE, XLP, XLU. Okay, and then even XLRE. Those were all in green while everything else was in the red. So there is defensive posturing here in the markets. This is that risk-off rotation that I'm trying to tell everybody about, that I'm seeing now. What makes this more of a risk-off situation, it's okay if these go up, but this is going up with stronger relative strength too compared to the S&P 500. So that is a little bit concerning. Not to say that this is the end-all be-all, market's top and we're going to crash, blah, blah, blah. But it is something that we need to pay attention to, because sometimes these rotations, these cycles, they can take still a long time to play out. As we're seeing, energy has recently been breaking out. Now, let's take a look at the weekly timeframes. I'll be honest, the weekly timeframes, they don't look too good. Okay, shooting star type candle, we got below the low of the week and we headed lower. We talked about that on last market recap. Still above that 10-week moving average, that can potentially hold as support. So what would I say? I say if we take out this low over here, then we might see some further downside. But that right there is that evening star pattern that we wanted to be mindful of in the prior episode. NDX, the NASDAQ 100, that looks a lot rough. But you can see here, we got below the low of that candle, and then we flushed down right down to that 10-period moving average, which is about the 50-day moving average on the NASDAQ 100. So another evening star pattern. And as you can tell, where did we go up to? We went right back up to both the 30 and 40-period moving averages, which are now about to have a crossover, which is not necessarily a good sign. And if this plays out more to the downside, this is going to all look obvious in hindsight, right? It came out, it back tested, it acted as resistance, and then started heading lower. Everyone's going to look at that with hindsight if that's actually the case that takes up. Now, honestly, looking at this chart, I still think that can potentially bounce up. We're right above the flat 10-period moving average, weekly moving average. And as you can see here, this is the area of resistance. So is it possible that we back test right here, suck in some more people, and then potentially head lower, try to take out these lows? Absolutely, and that seems like the trading range that we might be in. So if this low is getting taken out, be very cautious of that going into next week, which, by the way, next week is a shortened trading week. The market's not going to be open up on Friday. Now, if we take a look at IWM, also rough week, right? Down 4.67%. They got below the low of the prior week, right? And then we flush right down, closing below those key moving averages there too as well. So right now, as it stands, this area, this period of distribution that was up here, right, for over a year, right, it cracked down. Now we back tested and we're seeing some more weakness. Like we've been saying, if this was a period of distribution and big money was getting out of the market, why would all of a sudden they get back in right here? So there's clearly a lot of supply, a lot of trapped supply up in this area. So we'll continue to monitor it from a weekly time frame. Some might be starting to say, hey, this is kind of looking like a bear flag. And if that's the case, right, there can be a lot further downside. And if it goes down further, we have some key levels that we'll keep an eye on, but we'll save that for another episode because I don't think next week we're going to end up at 160. That would be absolutely incredible. Now, Dow Jones Industrial Average was down slightly, okay, not even 0.5%, so this one held up quite well. But you can see here the week close here, the week close here, the week close here. Very tight trading range on weekly closes, so probably very soon in the near future we'll be seeing some more explosive moves. Now, it's interesting to me that the Dow Jones Industrial Average is holding up this well, given that transports have been getting completely slaughtered, minus 6.71%. So either Dow Jones Industrials is going to catch to the downside, or we're going to see a bounce of relief here in transports. I personally took a position in transports with a pretty tight stop loss. I'm still in the position, but I figured there's a possibility that we can bounce up to potentially retest these levels, and then we'll see here if that selling continues. But right here, I haven't seen selling like that in the transports for quite some time, and the Dow Jones Industrial Average, if you look at Dow Theory, it's been holding up rather well. If we take a look at the daily time frame, let's look at the risk ranges. So the S&P 500 is pricing in a move to the upper edge to around 455, and the lower range is about 440. If you haven't watched this video, I'll link it in the description of how we can predict how far a market could potentially move in a given period of time. And, it's based off of a bell curve, right? So one standard deviation is this way, one standard deviation is that way. 68% of the time, it'll finish within that expected move range, which is this range. And, well, we did finish there last week. Now, how are we looking in these last 3 trading days? Well, we came down to the lower range, and we kind of just bounced and just hung around. Now, it did show me a low, a higher low, a higher low, a high, and then matching highs right here. This, to me, looks like it could be potentially flagging, so be cautious of that going into next week. Now, it's holding that 200-day moving average. We have some indecision-type candles, which tells me that, hey, being that it's undecided, we haven't decided yet whether if we want to start breaking back up to the upside or breaking down to the downside. So what are the key levels here? Well, you can look at the low and the high of the previous trading day to get a good idea. So 445.94 on the low end. So if that's broken, I think we can go test that 50-day moving average to the lower range. And if it starts getting above, which is the high, 450.63, I think it's possible that we go and retest that 455 up there or the upper risk range, okay? And as it stands right now, there's an episode that I put out that said, the market, get ready for the strength test. All right. So as it stands right now, this big move hasn't been validated yet by strength, right? It's all it's been doing is just kind of fallen down. So we need to see this actually hold somewhere and then bounce and take out that to really get some confirmed strength. You probably are starting to hear more people talk about an inverse head and shoulders. Okay, if that is the case and it plays out, awesome. Based on seasonality, I will say that it typically, what we've seen prior, it pulls down a little bit into the middle of April, then we shoot up. Okay, it looks good, but then it's like that sell in May sort of scenario hits in. Now, if we take a look at the MACD, bearish crossover, histogram is going negative, RSI is still above that 50 marker, so it's a little bit undecided at this particular point in time. If we take a look at the Qs, obviously the Qs finished weaker on the day, 1.4% down. Big tech got hit, and as you can see here, big move up, it's been just kind of heading down. So we haven't got confirmed strength that this is just a pullback yet. This could get completely reversed, right? That's typical to see, and we've said this countless times. It's typical to get 50% retracements of strong moves if there's no consolidation. So if that's the case, it could very well tag this lower risk range, and that would be roughly about a 50% back test of this very strong move. And if it does do that, that can be potentially into, the middle of April. And then we might see a potential run up, and then people will be calling out the inverse head and shoulders here too as well. Now, I don't think next week we're going to end up down here unless there's some, geopolitical event or something to hit the tape. There's going to be a lot of news-driven events that are very important to the market come next week, but I'm not going to dive too much into that in this episode. IWM, if we take a look at the risk range, 192.50 on the low end, which puts us at previous support. So support. And as you can see, this double bottom still hasn't even been tested to make a triple bottom, or it hasn't been taken out yet. So until that level is getting taken out, then I'd say that'd spell more downside for the IWM. As it stands right now, even if we come back down to 192.50, that would look weak. But overall, what does that mean? It means that it's just been going sideways at this particular point in time. So it's under the key moving averages. Relative strength is weak. MACD's turning over. RSI's below 50. It doesn't look all too good at this particular point in time. So we need more data. Okay, now if we take a look at these, the S&P 100, these are banks for the most part that are going to be reporting earnings next week. So we have BlackRock, JPM, these are some of the bigger ones, Goldman Sachs, and so forth, Citigroup, Wells Fargo. Okay, they're reporting earnings next week, so it's important to take a look at the XLF. The XLF put in this reversal type candle, right? And as you can see here, it started to break above that high. So that does signal to me that there's a very strong possibility that we can potentially start getting a little bit of a bounce this last trading day here. Maybe that was anticipation of earnings. Now, if we take a look at some of the larger mega cap stocks, I want to pull those up that are reporting earnings. So JPM, which is JP Morgan, very similar look, but to be quite honest, banks look pretty cruddy overall, right? A high, a lower high, a lower high, and you got low, lower low, and a lower low. So even if this comes to the upper risk range, that would still be a lower high at that particular point in time. So the trend remains down. Be very cautious and cognizant of that. Same thing goes with Goldman Sachs. Goldman Sachs finally had a good day, maybe in anticipation of the earnings, but it's been getting crushed. Nobody's been buying this all year, right? So 2022 is here, and this thing has been doing the same thing. A high, lower high, lower high, a low, lower low, lower low, and a lower low here. So on the low end, right, lower risk range is, just above 300. On the upper end, it's just below 340. So even if it gets up there, it's still in a downtrend. So be very just be aware of that, because if we do move up right here, that could actually present itself actually as a good shorting opportunity if you want to become bearish those financials. Let's hop into some indicators now. So housing continues to get wrecked. This is not a good sign. Now, we did see a little bit of strength on the prior trading day, but it also got reversed towards the end of the day there. So this has been a steep decline. I think it's possible to see some sort of a, recovery bounce at some point to maybe backtest these levels and see if it holds. But you could see here this big run up on the S&P 500. Housing, it did not participate in that. And housing is an incredibly important aspect to be paying attention to, incredibly important sector to be watching, because it points out, clear divergences. And as you can see here, we hit this double top, S&P 500 put in a higher high, but that right there was a warning sign in itself that housing didn't make another high. Okay, and then it started to sell off. And right here, we're starting to see a very similar situation, but the S&P 500 at this particular point in time has not been phased. And if we take a look at transports, next to Dow Jones Industrial Average, we kind of already touched on this, but notice how transports got completely crushed, and it's putting in potentially a double bottom here. And this is why I actually entered into a position. And there's actually some stocks, the main one actually in transports, in IYT, the top holding, looks like it can actually head lower. But as you can see, it's been kind of just going sideways, just quite aggressively moving back and forth within a channel. So I'm trying to play it to the middle range of the channel. But looking at this, and this is super down, and then you could see the Dow Jones Industrial Average, it hasn't even been phased. This could be an early indication that we could see more weakness in the Dow Jones Industrial Average to get hit. And as you can see, it is trading, lower highs, lower lows, and we're just up here at this particular point in time. So, it's not looking all too hot overall. We need more data to really feel a lot more confident. If we take a look at Michael Guyad's lumber to gold ratio, this is risk off. What does that mean? It tells us take your foot off the gas, okay? Take your foot off the gas, because we could very well see more continued volatility. If you look at his beta rotation strategy, this is also risk off. As you can see, utilities is upticking. It's below that zero. It's above that zero marker, which says that utilities is outperforming the S&P 500, which is more of a risk off type behavior. Also to note, the summation index continues to turn itself around, but the parabolic SAR is not back above it. I like to wait for that just to indicate that the trend may be shifting, right? It's shifted here, headed down, shifted here, headed up. It's not always perfect, but it is something to just identify a potential shift in the momentum. If we look at the old fool indicator right here, you can see it is actually crossed over and still bullish, but it looks like it's flat to potentially rolling over. So we'll continue to monitor that, but that remains on its buy signal until further notice there. Another thing to note is this is the trend indicator that I like to use, and every time it gets below this area, this red line, right, it's a 10 period on the hourly time frame with a 10 period moving average to smooth the data out. This right here, it triggered, and I warned everybody about it, but the market started ripping up. And, that already was a sign of caution to me. And as you can see, it rallied up, but the whole move, it got reversed. And now what I'm just calling out now, it does look somewhat like it's flagging, and it's pointing back down. Now, it hasn't crossed below that red zone yet, but if it does, I will bring it up. I'll either post it on Twitter or I'll talk about it in my stock market brief. Let's look at the dollar. The dollar, it's been very strong, but I think it's time for the dollar to maybe take a little pause here. Put in a shooting star candle. It's wedging very tightly right here. So to take a little bit of a breather, potentially backtest that 20 period moving average, and then see if it can continue its strength. That might offer up some relief in commodities. Mainly what I'm looking at, silver and gold. So let's hop into commodities right now. So gold, MACD curling up. Looks like it might be getting ready to go for a little bit of a run here. So we're going to keep an eye on it. But as you can see, boom, it's getting pretty tight. Okay, the price action, it's tightening up here. I think that there's a possibility in the very near future that we might see gold pop back up. I don't know if it's going to go and try to test these highs or if there's going to be an event to push this thing right back down. But what I do know from a risk management perspective, price is tightening up. There's a couple good signs, and it looks like we're going to be seeing an explosive move, whether that's this week or next week. I think it's in the near future. Same thing goes with silver. So let's take a look at silver. Silver, you can still see that wedge taking place right here. And me personally, I'm bullish silver right now. You can see price action is wedging tightly. MACD is starting to curl back up. This looks like it can start taking off here in the very near future. So we're going to continue to watch that from a risk management perspective. It makes sense to me, right? Low risk to potentially high reward. So for example, right, if you enter in above the 200-day, 20-day moving average and on a breakout, let's just say, and then you put a stop loss below this low right here, or the 200-day moving average, and then you want to play it to the previous high, your reward could be here and your risk could be right here. So it's a pretty good risk to reward. It makes sense. So it doesn't matter if you're wrong. What matters is what you understand about managing risk, and is your possibility of reward greater? And I personally think that this looks like it can be. Now if we take a look at oil, let me expand this up here really quick. So oil, it still has broken that trend and it's below that 50-day moving average. However, this could very well just be, like we talked about, a potential fake out and then a rip higher. Notice how price action, it's been, it was consolidating, getting very tight, and then we had that explosive move out with some stronger volume. So I still think that there's a possibility that it can head lower, but energy stocks are telling a little bit different of a story here. So we'll wait to see if it recaptures this 50-day moving average, and it was somewhat of like a bear trap. But as it stands right now, it's inconclusive at this particular point in time. A couple other commodities that I want to call out is wheat. Wheat looks similar to gold, right? Just the way that it's kind of flagging right here, consolidating. Price action's getting very tight here. This is wheat continuous contract, but if you wanted to, you can look at like WEAT. I believe that's an ETF that you can look into. MACD is starting to curl up. So yeah, if you had a stop loss under this pack right here and then you play a breakout and you just want to play it to the top, or even right here, your reward is up here and your risk is obviously a lot smaller. So from a risk to reward standpoint, it looks pretty good. If you take a look at corn's a similar situation. MACD's turning up, hasn't had the bullish crossover yet. Price action consolidating, getting tight from a risk to reward perspective. If this fires off and you have a tight stop, it could be also another good play. So those are a couple of commodities that I'm looking at. Let's hop into bonds and yields now. Bonds and yields, man. Tell you, they've been volatile. Now, this inverse head and shoulders full measure move would bring us to around 30, which is 3%. This is the 10-year yield, and it looks like we're headed there. Okay, there has been no signs of slowing down at this particular point in time. Maybe that might change coming into next week. If we look at the TYX, which is the 30-year treasury, this thing has been firing off too. If you look at mortgages, holy moly, those rates have been firing off too. You're probably hearing that if you're in the real estate market, if you're a real estate agent or whatever. My brother's in real estate, and man, he's been talking like, yeah, it's crazy. So as he stands right now, look at that week, up 13.28% on the week for this, and it's clearly looking like it can head higher, right? This inverse head and shoulder, we broke out, we back tested, and we fired off right here. So be very cautious right there. All signs right now are pointing higher. This, it could change, but holy moly, like it looks pretty strong. If you look at like the 5-year yield, look at this thing. This is at about 2.8%, which is pretty crazy because we talked about this bottoming pattern down here. We talked about it here, right? And then it broke out, and who would have thought that it would fly like that? I definitely did not think it would fly like that. It sure as heck did. But at 2.8%, you're looking at this, and it's at just about the same. We're inverted, right? So there is clearly warning signs, and the market is trying to tell us something here. But the short end of the curve obviously still remains pretty steep, and that hasn't been affected. So it looks like the Fed's going to be obviously raising rates, and if you looked at the FOMC meetings, it looks like it's going to be quite aggressive. So that means to me that they're going to just be raising rates until obviously something just falls apart. Now here from a longer perspective, if we take a look at the 10-year yield on a monthly time frame, if we get that full measured move up there to around 30, that puts us actually at the upper channel or upper area of resistance that we've been in since, 1982 when we peaked here. So there's a possibility that does act as a very strong resistance. And that's why you'll probably start hearing people talk like, okay, I think bonds might be actually a good opportunity. And if that's really the case and we start to see bonds start to rip, that could be that final, nail in the coffin for that risk off type behavior. We're seeing it in various markets, but we haven't seen it in one that really does matter. And, we're coming up to a main area of resistance. Maybe that's the case. TLT, when we take a look at the TLT, clearly it's been in a channel, right? It dates back to just, mid 2002. See support all the way up, and we're basically right here around that key level. So hey, as we break down in bonds, it's over, game over for bonds. It's hard to say, but as it stands right now, they've been getting absolutely crushed. And on this move down too, look at that volume. It's just boom, 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 heading higher and higher. So a lot of volume on that way down too. So it's gonna be interesting to see how that plays out now. This is also very interesting. This is looking at the ratio between S&P 500 and TLT. So we've been saying the S&P 500, it's been outperforming TLT, so this has been heading higher. But meanwhile, the S&P 500, it hasn't been doing all too hot, right? We saw a big run up here, but as you can see, the ratio put in clearly a new high. Meanwhile, the S&P 500 is not following that. And for the most part, they do move hand in hand, but you can see divergences at times. And right now, we're seeing a very big divergence. So I want to walk you back. When the ratio puts in a higher high, but the S&P 500 puts in a lower high, we've seen the market sell off. Okay, right here, put in matching highs, market sold off as that ratio put up another one there too. And then right here, we're at a very big divergence where, we have a high here and a much higher high, and we have a high and a much lower high. So this very well might be an early indication that's saying that we could very well start to retest these lows, which means to me 2022 is just going to be just a mess around type of move. Now, this ratio, by the way, also looks for positive divergences. Remember when we were comparing 2008 to now? Well, we also pointed out this ratio from a positive divergence perspective. We talked about this ratio also being positive, where it showed the market ripped up higher. So interesting stuff altogether. There's clearly a rotation. Clearly, we need to keep our foot off the gas slightly and pay very close attention to what's taking place. That's all I have for you on today's episode, everybody. Hope you got something from it. Have a wonderful